In addition to the price to earnings (PE) ratio and price to sales (PS) ratio, another important metric for stock analysis is the return on equity (ROE) ratio. The ROE measures a company's profitability by calculating how much profit a company generates with the money shareholders have invested. In this video, we will explain what ROE is, how it is calculated, and why it is a useful tool for stock analysis. Definition of ROE. The ROE is calculated by dividing a company's net income by its average shareholders' equity. Shareholders' equity is the value of assets that remain after a company pays off all of its liabilities. For example, if a company has a net income of Rs 10 million and shareholders' equity of Rs 50 million, its ROE would be 20%. Importance of ROE. The ROE is important because it provides insight into a company's ability to generate profits from the money shareholders have invested. A higher ROE generally indicates that a company is generating more profit with the money shareholders have invested. Understanding high versus low ROE. A high ROE may indicate that a company has efficient operations and is able to generate significant profits from its assets. However, it is important to consider other factors, such as a company's debt levels and growth prospects, when interpreting the ROE. A low ROE may indicate that a company is not generating significant profits with the money shareholders have invested. Comparison with industry averages. As with other financial ratios, it is important to compare a company's ROE with the average for its industry. A company with a higher ROE than its peers may be generating more profit from its shareholders' equity and may be a better investment opportunity. Limitations of R.O.E. While the ROE is a useful metric, it should not be used in isolation. Other factors, such as a company's debt levels, growth prospects, and competitive position, must also be considered when making investment decisions. Conclusion. In summary, the ROE is a useful tool for stock analysis, providing insight into a company's ability to generate profits from the money shareholders have invested. By understanding how the ROE is calculated and how it can be used to evaluate companies, investors can make more informed investment decisions. If you like our content, then don't forget to like and subscribe our channel. Thanks for watching.